Welcome to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Summit Puri. I'm the Co-Chief Investment Officer here at Whitaker-Myers Wealth Managers. Thank you so much for tuning in. U.S. stocks dipped slightly by week's end, but still notched their fourth consecutive monthly gain in August. A late week pullback led by tech and AI shares such as Nvidia came after a rally sparked by dovish signals from the Fed, with hopes for a rate cut as early as September. Inflation trends remained steady, with July's PCE data broadly in line with expectations, reinforcing market optimism around easing policy. So let's take a look at this in more detail, starting with our key market indicators this week, as well as we'll continue our discussion by reviewing the contributors and detractors of the market, highlighting the key drivers of the market as a whole. We'll do this all while looking at both equity and bond markets to provide a more comprehensive view of market movement, as well as the impact to your portfolios. So with that, let's hop right in. First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta GDP Now report shows a projected 3.5% growth as of August 29th, which is much higher than what we had projected or what we had shown last week at 2.2%. Next, each week we look at initial claims for unemployment insurance for a gauge into the front end of the labor market. This week, initial claims data showed that it fell by 6,000 claims, ending at 229,000, while continuing claims also fell slightly to 1.954 million. Next, we're watching mortgage rates closely to see how home affordability is trending. This week, we saw further downward movement in mortgage rates. Both the 30-year and 15-year mortgage rates remain relatively steady, but with a little bit of downward movement, with the 30-year ending at 6.56% and the 15-year ending at 5.69%, respectively. Next, we'll look at investor sentiment. Now, one measure of investor sentiment is the bull-to-bear spread. The latest update shows the bull-to-bear spread rose from a negative 13.9% last week to a negative 4.84% this week. Another measure of investor sentiment is the VIX, or volatility index. Generally, the VIX rises when stocks fall and declines when stocks rise, often showing an inverse price to action relationship to the S&P 500. Remember, VIX values above 30 are typically linked to large volatility resulting from increased uncertainty and fear, while values below 20 generally correspond to stable market periods, and this week the VIX ended at 15.36. Next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating an 86.4% probability of a 0.25% decrease and a 13.6% probability of no decrease in September. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which was our proxy for growth and growth in income, but only when considered together, ended positive 0.34%. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, was positive 1.19%. And the MSCI EAFE, which tracks international stocks of developed countries across the globe, excluding the U.S., was negative 0.96%. And the winner this week goes to aggressive growth stocks. Remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. If you'd like an unbiased review of your portfolio, don't hesitate to connect with one of our advisors today. So with that, let's jump right into our discussion around contributors and detractors that moved these market indices in the past week. We had a number of contributors that drove the markets last week. Now, on one side, we had the Federal Reserve, which is anticipated to consider an interest rate cut due to the weakening labor market. Now, unless the upcoming jobs report shows unexpected strength, it's highly likely that we'll see a rate cut in September. What we've seen, though, is hiring has slowed, averaging to about 35,000 new jobs per month from May to July, with August projections at around 75,000. The unemployment rate is expected to rise to 4.3%, which is the highest it's been in nearly 4 years. We also saw the PCE inflation data, which is the personal consumption expenditures data, coming in largely in line with expectations. Core PCE, which excludes volatile food and energy costs, hit 2.9%, which once again bolstered hopes for an easier monetary policy. Now, even though we ended positive for most major indices last week, there were more detractors this week than there were contributors. So on the equity side, we saw concerns over market concentration around mega cap tech. Now, this is important because these mega cap tech stocks now represent a record share of the S&P 500. There was also continued worries about Fed independence amid political interference, which added a layer of caution to sentiment. AI-related stocks face pressure after reports that Alibaba is developing its own AI chip, potentially impacting NVIDIA's prospects in China. Consequently, NVIDIA and other semiconductor stocks declined, while Alibaba's stock surged nearly 13%. A U.S. federal appeals court ruled that most of President Donald Trump's tariffs are illegal, which could lead to the government repaying billions to importers. This decision will likely head to the Supreme Court, and there's certainly more to come on that. In India, markets closed lower amid global uncertainties, particularly due to concerns over newly imposed U.S. tariffs on non-Indian exports. The Nifty index ended August on a weak note with the banking sector experiencing significant declines. We also saw global equity fund inflows, which slowed significantly, with U.S. equities funds receiving $571 million, down from previous weeks. Financial sector equity funds, however, experienced a strong rebound, gaining about $1.5 billion, which is the highest in 8 months. Technology funds also saw solid inflows of $533 million. Now, on the fixed income side, the widening gap between short-term and long-term yields, especially the 2-year versus the 10-year spread, suggests growing market anxiety about inflation and fiscal risks, despite expectations of a Fed rate cut in September. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest videos on your feed, including new content released by our team, please make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. Thank you once again for watching. We look forward to seeing you next week.